So the markets are flattening out today after numbers show more Americans than expected filed claims for jobless benefits for the first time. For perspective, we turn to Mark Martiak, Senior Wealth Strategist at Premier First Allied Securities. Mark, good to have you with us.
It's good to be here. Thank you.
Well, in this environment here today, how do we play this? Is there any reason to be in this market when it doesn't seem to have a sense of direction?
Well, I believe there is a reason to be in the market, and the reason is very simple. The valuations of equities are still extremely attractive. And what I'm talking to my clients about is staying the course, staying focused, but be prepared for pullback, because we'll see some volatility, more volatility than we've seen in the first quarter of this year. So arguably, initial weekly jobless claims were good, but we expected better. And then for the week ended April 7th, the prior week, they were revised upward, initial weekly jobless claims. So that causes some concern, not only among investors, institutional and retail alike, but especially among my clients who are no different. And added to that is the fact that Intel and IBM reported lackluster earnings yesterday, and so the market is feeling the result of that today.
What are you expecting as far as the triggers for volatility? You know, you look at the VIX since the start of the year, it's down about 14%. We're trading at about 18 right now. What will be the catalyst that will make this market more volatile than what we've seen here?
Well, we're going to start to see some more news out of the European Union with regards to Spain, and I believe that Portugal will probably be dealing with a second bailout. So that's cause for concern. Europe is still on investors' minds, and that's not going away anytime soon. Jobless claims, we're going to watch that trend very carefully. So that's always a cause for concern, because the Fed is clearly focused on creating more jobs, and they're looking at every report that they can. But always remember, and I tell my clients this, it's not the initial report on jobless claims, it's always the revision afterwards. Look at the revised numbers when they come out on economic data. And then finally, whenever we hear in the States or anywhere in the world, Canada is no exception, that China is experiencing a global slowdown in consumption, that has a ripple effect. So any of these factors can influence sentiment and the market conditions. But I do believe the market will have some volatility, some pullbacks, but I think we're still on an upward trend, and I'm recommending to my clients that they continue to look at equities with PE ratios of 18 or better, and look at financials and look at technology. I believe they're very, very strong sectors that to participate in, as well as fixed income.
Why tech and financials? Does the rain in Spain fall mainly on the industrials?
I would say that's definitely part of it. Plus, technology is doing better and better. And don't forget, we've got Facebook that will be coming out in the month of May with their IPO. Don't forget, we're in the midst of earnings season, and most companies have been reporting very solid growth in their earnings, beating revenue and earnings per share estimates. So these two sectors, technology and financial, just happen to be the benefactors. Technology is growing the world over. You can look at specific companies. I prefer to look at the sector. Financial has been down for so long, and it's very important that financials coming back. And I like financials globally. I like financials in the European countries, such as France, Germany, the UK, the Netherlands, and Switzerland, as well as financials in North America.
Okay, tell me about the financial services sector then, and what particular type of financial you like. You like ones that are exposed to the consumer, or ones that are more exposed to the trading desk?
I like the ones that are exposed to the consumer. And very simply, because consumer spending has also had an upward trend. And here in the States, of course, consumer spending accounts for 70% of GDP. So I really like the banks that are well diversified in their product and offerings mix, and I think that they're doing well. And you're seeing that in terms of companies, financials, the Bank of America, to name one in particular, Morgan Stanley. They are doing well. But the ones that are exposed to consumer, that offer a broad range of diversified products, I believe are the companies that are going to do extremely well. As consumer spending picks up and we come out of this malaise that was caused by the subprime crisis back in 08-09.
Does the same apply then to the technology space? Do you like your Apples and your Microsofts over your Ciscos and your Oracles that are in the corporate and enterprise space?
Well, I won't comment specifically on any of those companies, but I will say I like the technology sector overall. I think between routers and software, between retail with one of those companies you just mentioned, and the development of their R&D and software and technology, overall I believe those companies are growing at a nice clip. I mean, just a few weeks ago, last week in fact, when you have a company like Facebook paying what they paid for Instagram or for the photography company, the money that they paid in the combination of shares and cash, that really is mind-blowing to many. Although for them, for the parties involved, they're making the right decision on that deal because there's 30 million customers with this photo sharing application, and that's a good young company, and clearly I think they have room for a lot of growth. So there's a growth story in technology. There continues to be a growth story in technology.
Well, Mark, we appreciate your big picture outlook. Thank you so much.
Thank you.
Mark Martiak, Senior Wealth Strategist at Premier First Allied Securities.